This episode is brought to you by Interactive Brokers. World events, they unfold in real time. Now you can trade them. With IBKR prediction markets, trade election, climate, and economic outcomes along stocks, options, and bonds, all on one integrated platform. These are simple yes or no contracts priced to reflect the market's view of probability. And if your prediction's right, well, you receive $1 per contract and earn interest on your position while you're invested. IBKR prediction markets turn market expectations into actionable trades. Prediction contracts are not suitable for all investors. Learn more at ibkr.com/predictions.
The Disciplined Investor is all about you, your money, and the markets. Sit back and get ready for this edition of the Disciplined Investor Podcast.
This episode of The Disciplined Investor is sponsored by Horowitz & Company. If you're looking for a portfolio manager, look no further. Horowitz & Company. From seed through harvest, cultivating financial success.
The war is back on. Oil on the rise. Some are saying the AI trade has peaked. I have some thoughts on that. Earnings season just days away. And we'll talk about that with our guest, Gavin Maguire, Senior Analyst at Briefing.com. All this and much more on episode number 981 of the Disciplined Investor Podcast. Hey, it's Andrew Horowitz here, and we're going to be talking about a lot of different things on this particular episode. But one of the things I thought that we would talk about is some of the things that are going on in the world of tech and AI, because a lot of people have been asking questions about that. We're going to probably get a little deeper into this with our guest today, but I thought we would talk about some of the things that I thought were interesting because I went back and did a little research, and we looked back at a particular period in history to find out whether or not there was any similarities, differences, and maybe possibly what's in store for the future when it comes to this AI trade. And, one of the biggest things that we saw is that investors are suddenly, maybe, they're looking at this and focusing on the possibility, just the possibility that the AI infrastructure build out maybe creating more capacity than near-term demand really requires. And this is a big issue because we saw announcements from companies like Meta. That was the big one. Meta was the big one, and that was an issue that I think we need to really focus in on. But also we saw some inklings and kind of mentions by companies like SoftBank and OpenAI as well. In fact, SpaceX also had some things to say. So the biggest tell yet and the biggest talk that we saw right now was from Meta. And they came out with a discussion and they said that they're basically creating a cloud business that is going to be selling some of the excess, they didn't really say it this way, but this is what it sounded like, the excess compute capacity to customers. It's kind of surprising because for a long time we heard about just the opposite, that the demand is there and compute infrastructure is not there. In other words, the supply-demand curve was kind of off. And the fact is that now both Reuters and CNBC are reporting that this unused GPU data center capacity that they have is going to be available to lease and rent. Really? That was only for internal AI projects for a long period of time. And now all of a sudden, we're going to be seeing this used for outside and others. Interesting. And really, the significance of this, I think, was that Meta is expected to spend, $150 billion on AI infrastructure in 2026. And that being the case, this large deployment, this is one of the biggest CapEx deployments that we've seen, is really now all of a sudden coming into question as to why are they doing this? Is it possible, maybe, that OpenAI and SpaceX or XAI and Meta are going to do these things in order to grab some revenue initially as they're continuing their build out. But yet again, wait a minute, you have to question, I thought they didn't have enough. They didn't have enough capacity for what they were doing right now. Now, Meta may be put in a different category because a lot of the compute capacity that they were using was for their own projects, and maybe they've reached the limit of where they can get to for the time being. When you look at OpenAI, you look at Claude, you look at even Amazon for that matter, maybe there's something different going on with those. But the fact is that Zuckerberg recently discussed this overbuilding. And he specifically noted that if Meta ended up with more capacity, they'll sell the compute was an option. So maybe that's what's getting people a little bit concerned. But I guess we have to go back to why is there overcapacity? Probably there's some reasonable explanations, I would think. You'd have to think about the training capacity is a little bit lumpy. We don't have a straight line on this where we're seeing that there is an absolute level of straight line training that's going on to put into the models. And sometimes it gets stalled. And sometimes when we see the building and the data centers being built, maybe they don't have the capacity for that. Maybe some of these frontier models, which require enormous compute for training, maybe they're calming down a little bit and they're becoming maybe not developed, but emerging. Interesting. Is it possible that Meta built ahead of their demand? Maybe. Is it constrained to just Meta? I don't think so, because we're starting to hear things from OpenAI and from SoftBank as well. So maybe there's this whole issue with inference that's going on right now. The efficiency keeps improving. And maybe we're seeing that the next level of agentic isn't going to require as much, because what we've done is with these LLMs, the large language models, the training, which took so much, that now yields into inference that now morphs into agentic, that is pre-built to a degree. So there is something to be said about that. But SoftBank has a little bit of a different problem, because when we look at Stargate, we look at SoftBank, we look at these issues with OpenAI and also with XAI. When we looked at Oracle and others, the original vision was this massive AI infrastructure platform, right? That was reported in 2025 when the commitments were being made by these companies to fund things like Oracle. And have you seen Oracle stock lately? It's in the toilet. I mean, there is no question that Oracle is the canary in the coal mine when it comes to this CapEx expenditures and possibly the overexpansion of this. But we did see that OpenAI and Oracle expand into this project, right? In huge numbers and commitments on this. And maybe this demand is softening a little bit. But the bigger question, all of this, just take everything we're thinking about here, is what happened back in the 1990s with the fiber optics bubble of the late 1990s, because the build out of what we're seeing now kind of resembles this. I was thinking about this and I was looking back on some history, and I was thinking about, in the fiber optic build out of the 1990s, it was all about this build to the networks first, right? This huge build out, which is kind of like the same thing we're seeing now in building the GPU clusters and the infrastructure of the data centers. We had this assumption back then of future demand. Does it sound familiar? And it was going to be enormous, and there was going to be unconstrained need for a build out. And then we had the massive capital spending to fund what was then the assumed amount of fiber optics that were going to be needed. Again, just cut and paste on what's happening now. And then we had some overbuilding. Now, it was interesting. This was in the late 1990s. So 1997 through 2000, we had the long haul telecommunications, fiber optics needed. We had the internet technology growth that was going on, the capacity, the backbone that was needed for all of this. That was really something special. We had the data transmission infrastructure and the undersea cables. Remember that was going on? There were companies that were there and that we look at now and like, who are they? I kind of remember the names, but we had names like Global Crossing, Level 3, WorldCom. We had 360 Network. There was a whole bunch of XO Communications, Williams. Remember these names? Where are they now? If you've been investing and thinking about what's going on from the last 15 years, you'd be like, who are those companies, right? Those are companies that either don't exist or were absorbed into others over the last couple of decades because they don't have any need or any capacity requirements. This was the letdown of 2001, 2002 of all of these, and it collapsed. It totally collapsed because demand, while it kept growing, the fact was that capacity prices, profit margins, the telecom company valuations were out of control. It all didn't fit. And I was thinking, is this similar to what we're seeing today? Is this the same kind of situation where we saw growth in fiber in 2000, or actually 1997 through the 2000s, to where we see GPU growth now, where we saw bandwidth needed and we have compute needed now, where we had internet traffic forecasts saying that we were going to have this huge amount, and the realization being, yes, huge, but the build-outs were meeting the demand. Same thing with AI demand forecast of what we're having today, because what we're seeing is this talk about unlimited amounts needed. Debt funding started happening. The later we went into the cycle, we saw a lot of this happening with companies already. SpaceX became public, $25 billion or so. We saw that Oracle is loading itself with debt. We're seeing Amazon came out with a debt offering just recently. So this CapEx build out funded with debt, with equity at first and money that was coming in from all over the place, turned into a debt-funded build-out, which we're seeing now to a degree. And then back then you had overlapping networks. Aren't we seeing that now? Overlapping data centers that are being utilized for pretty much the same thing. And who are going to come out to be the winners? Does anybody really think that all of the names that we're seeing today are going to be all of the names in the future? There's going to be mergers. There's going to be acquisitions. There are going to be some that just go by the wayside and just be like, you know what? That's redundant. And the fickle nature of the user is going to come into play, and the effective ability for the capitalization and the monetization, more importantly, of what is going on right now is going to come into question. So, yes, the whole time you're listening to me talk about this, let's say it. Let's admit it, that it is different now. There's one thing that we are seeing that has some similarities. Too many companies that are building, whether we have Meta, Microsoft, we have Amazon, Google, xAI, OpenAI, SoftBank, Oracle. You got CoreWeave. You have companies that are in multiple tiers down. Anthropic, that are, well, they're up there. But those companies that are fighting with each other, some are well capitalized and some are okay capitalized. The major difference that we have today with all these companies, the OpenAI, Anthropic, Google, with Gemini, xAI, et cetera, they're consuming extraordinary amounts of compute already. And there is no question whether demand exists. Back then, there was a question, is this thing going to go? Is this internet thing going to actually fly? Much different than we have today. But the question is, will demand continue to grow fast enough to absorb all the trillions of dollars? Yes, trillions of dollars of capacity that is being announced almost on a regular basis every single week, if not bi-weekly. Here's my take. I don't think that the market is saying that there's this broad AI bust that's coming. I don't think that's the case at all. I don't think we can make that case at this point so early on. And even though there are a lot of similarities to the fiber build out back in the 1990s, investors are trying now, and they're getting ahead of things because they've seen what happens. They're trying their best to distinguish between the AI demand, which is extremely strong still, there's no question about that, but the AI infrastructure returns that are going to happen. Again, the monetization and ability for many of these companies to actually form the benefit to the investor. That's what's much less certain right now. And when we go back to looking at Meta, when we look at how they are now selling some of their compute, maybe they prudently overbuilt and they're not get caught up to where they need to be, but they will be the player. That's a possibility. That's definitely a possibility. For SoftBank and Stargate, maybe it's an execution issue right now with financing, timing of when the money is going to come in, how much the need is for right now and where this is going to go. And I think the biggest risk going forward is not that the data centers will sit empty. And some are talking about, well, what are we going to have? Are we going to open up pickleball courts in all these data centers when they go bust? Are we going to have ice rinks in that? I don't think that's the case necessarily at this point where we are today, because much of the data center build out that's really required that we could see is still not there. But the question is return on capital going to fall sharply as more players build capacity? And the assumptions that are being laid out right now with the valuations on many of these companies, is that what's going to fall prey to a overzealous build out that's happened? And from an investment standpoint, I think we need to look at, these companies like Digital Realty, and we need to look at CoreWeave, at Oracle, NVIDIA, the hyperscalers. If they're renting out overcapacity right now, that's going to see some trickle-down effects to many of these other companies that are building, leasing, and spending. So something to think about right now with all of this going on. And I think that's the questions that really is going to be front and center on many people's minds when it comes to the AI trade right now. So something to consider. Now, before we go on any further, I want to mention something because a lot of people have expressed some interest in this. And if this is you, I want you to listen up. Have you recently been let go by Microsoft? Well, we're getting a lot of inquiries about that, helping people understand what to do with their benefits, discussing options they have with options and the stock options and the restricted stock and any kind of grants they may have, as well as their 401ks, et cetera. So I want you to reach out. If you were laid off by Microsoft or Amazon, whoever was doing it, Meta recently, you can go over to thedisciplinedinvestor.com and we'll give you all the information. Just go on, click the Ask Andrew, and we'll make sure to get you set up. We'll set up a time for you and I to get together one-on-one, and we'll discuss it and make sure you are well taken care of. We'll make sure you're definitely well taken care of. All right, listen, I want to talk about IBKR, and then we'll get to our guest, because one thing we do know, that you research your investments, you analyze markets, but the question you have to ask yourself is, have you researched your broker? For the past 3 years, Interactive Brokers' individual clients averaged 24.3% annual return, beating the S&P 500. Lower costs, competitive rates, and access to 170 plus global markets help investors keep more of what they earn. The broker you choose matters. Interactive Brokers, member SIPC. Learn more at ibkr.com/performance. Again, that's ibkr.com/performance. Let me tell you a little bit about our guest today. His name is Gavin Maguire, and he has more than 20 years of market experience with briefing.com. And that's one place. He goes back a few more years at other places. He contributes to the real-time commentary on the Live in Play page and helps monitor market-moving news, rumors, economic data, earnings reports, geopolitical developments, and broader macro events that shape investor sentiment and the market direction. And if you are a briefing.com trader subscriber, Gavin provides daily trading and investment ideas under the event custom ticker with a focus on the daily trades in the major indices, including the S&P 500, of course, along with select longer duration opportunities in ETFs and individual stocks. He hosts the Sentiment and Flow Show, and he's a smart guy. He graduated University of Scranton, Pennsylvania, based in North Carolina. He talks about options, technical analysis, and all that. So let's get right to it. So welcome, Gavin. Welcome to the Disciplined Investor Podcast. How are you?
Doing good, Andrew. How about yourself?
I'm great. Thanks so much for asking, and I'm really appreciative of you coming on board. We've talked many times in the past, and obviously, I know you're going to be a wealth of information for the listeners, so that's good. I want to go back for a second and get a little bit of information. I want to talk about you from the aspect of, the idea of, well, how did you get to this point, and how did you get to your position right now, and where are you? Because you were at Zacks, I believe, in the late 1990s, right? During the internet boom. And then you went to something called trading markets after that. During, I think, which we could probably consider a pretty transformative period for online investing. And I guess the question I have for you is, during that period of time, what was it like watching the retail investor revolution, I think it was a revolution, unfold from the inside?
It was pretty interesting times for sure. I was out in Chicago in 98, which is where I started with Zacks. And I was working on both the financial content side and the advertising side. So, 98 through 2001 is when I was there, which is, of course, right during the dot-com bubble. And it was just really crazy just seeing things take off there at that point. Everybody was dying for content. Zacks was at the forefront there with their earnings per share estimates.
Yep.
Everybody wanted to get that data on their site. It was just starting with banners and different advertising scrolls that were just coming into their nascent being. So, it's just impressive seeing everything just kind of blow up for the couple of years. Then, of course, the crash in 2001. But it wasn't difficult to see it coming. I remember there was a French bank that I had as a client that I was selling them data. They couldn't speak a lick of French or English. I couldn't speak any French, yet I was able to sell them a $250,000 contract.
Wow.
They knew that they needed everything. Right there is when I probably should have figured that the bubble's coming here.
Yeah.
But so it's just real interesting to kind of see that time and just everybody scrambling for it. Kind of probably what you see a little bit to some degree in AI right now, right?
Yeah.
So just built up and then just kind of fell apart right on a pin there. Everybody started rolling back their contracts. We had a bunch of defaults and so on and so forth. But then I went to go work for Trading Markets, which was they basically sell a lot of different trader content, how-to trading profiles and products like that. So that was going great. They had a great trade show that was about to kick off, and the dates of that was right around September 20th, 2001.
Oh, yeah.
That obviously did not go off, that trade show.
Yeah.
So, I ended up moving on from there and moving to Briefing, where I've been there now for 24 years. So started off as an equity analyst for them, and then I've just kind of worked my way up. And now I've basically been a jack of all trades for the last 2 decades, covering econ data, macro data, earnings, kind of whatever's hot. And, I run their trader audio program and such. But
well, I mean, listen, because I told you this, I'll admit it. I'm not embarrassed to say so. I'm a bit of a Briefing fanboy. I love the work I love the work that you guys do. And you joined back in 2003. And I want to talk about some of the components of Briefing. But if I was to give you the 2003 version of Gavin Maguire, if I was to give you a copy of today's market headlines, right? AI, $1 trillion deals being done, CapEx is out of control, meme stocks, crypto, retail options trading, all that, and 24-hour financial media, what part would you, back in 2003, find hardest to believe?
Probably crypto, I would think.
Because it's hard to believe. It's hard to believe this today, so I guess that's why.
I'm not a big crypto believer. I understand storage of wealth, and it's fiat currency, right? As long as people believe in it, then that's all that really matters. But if you were to tell me that they just created something out of thin air that would be traded around by crypto bros and Number one, I would have bought it.
Right.
I definitely would have bought a ton of it. I probably just would have thrown everything into it. But hindsight being 2020, but that probably would have been the most difficult thing. Certainly the AI would have probably been a little bit difficult to grasp. I like reading my fair share of sci-fi and everything, so maybe I would have been into that.
Yeah, this is right out of 2001: A Space Odyssey. So you got Dave.
Yeah, exactly.
So maybe that wouldn't have been that hard to believe. So, but one of the things is you also help build a lot of products. You build content and that the traders use every single day. And when I say traders, I want to make sure everybody understands this. Well, in my opinion, this is my opinion. The briefing product is not just for traders, right? You have a series of, I would call it from basic to advanced. I guess that's the best way to describe it. Basic to advanced of products. Some of them are free, frankly, and you can get them on a lot of sites from your reporting and data information. But you've helped build that, and I guess, looking back over your 20-year history and tenure with briefing, what kind of things do you think that 20 years ago people we don't need it anymore, right? From what did we scrap over that period of time from a data, content, information, and I guess maybe I'll follow it up with, what do we need now more than ever?
That's a good question. In terms of scrapping, I mean, I feel like people are so hungry for data information that there hasn't been a lot that's fallen off, really. Our earnings coverage is always one of our top things, and just kind of taking them through the entire lifeline of the earnings from the prior quarter, through the preview, through the actual report, conference call coverage, and then the follow-up. That's all stuff that we've really kind of built on, and just kind of provide that steps to people to understand why the stock does what it does.
Right.
For instance, Samsung, right? Blew away expectations on Monday night, and comes in and it's down 8%. And, and obviously got SK Hynix getting ready to trade. You got Micron that's been so hot, the DRAM ETF in general, and just kind of understanding the process of, well, it's sold, and this is particularly for new people, where, well, it's run up 400% over the last 12 months or so. So, that's its expectations and just kind of running ahead of itself and pulling back in on the sentiment front. Things like that are really stuff that we like to emphasize. But in terms of stuff that we have covered through the years that we've chopped off, I can't really think of anything offhand, just because people are so hungry for data and for information. I would say one of the things that we do like to kind of look at a little bit more on the occasion is options positioning, just because it's become such a big. Yeah, I mean, what we just had the June expiry 2.5 weeks ago, and it was a notional value of over $7 trillion. Well,
that was a quad witching, and that was out of control, by the way, because not only do you have what's going on now, but that was also on an off day, I think it was, because
it was a Thursday because of Juneteenth.
It was all that going on, but that's another topic entirely to get into with regard to the options and all. I think if you would ask me that question, the same question, like what don't we need anymore? It almost seems like PE ratio is kind of like, everybody knows that that's not the only thing. It used to be only like, what's the PE? What's the PE? Yeah. What's the PE? It's like, all right. You try to explain to people, PE in a vacuum doesn't mean anything, right?
Yeah, I mean, value, it's all eye of the beholder, right? I mean, exactly. That's why you could have Walmart trading at 40 times forward earnings and Target trading at 16 times. And people are like, well, they do the same thing, right? And then you kind of break down the consumer discretionary spend. But yeah, right. I mean, understanding that, and even now, right, we're trading at about a 21 time forward PE ratio. And everyone's like, well, that's so expensive. But it's really not, because the efficiency for the U.S. has gotten so, corporate America has gotten so much better that margins continue to expand. We have a run of 14% margin growth over the last couple of quarters. So yeah, value investing has definitely not been at the forefront. You probably see that with Berkshire, where they're sitting on $370 billion in cash, because according to Buffett's model, none of this is meeting its value. But investors have really thrown that out at the moment. So it's just kind of interesting to see that.
I think though Buffett's models have changed when they need them to change, right? Remember when they bought Apple? That was not that was like
wasn't popular.
But that was not a Buffett buy at the time. The only thing that was going to happen was the hope that, because they weren't even, if I'm not mistaken, I don't think Apple at the time was shareholder friendly. It came after that. That Apple
most tech's not, right?
No, most tech stocks were never shareholder friendly.
Yeah.
But all of a sudden they pay dividends now. It's a whole different world. In fact, when you look at the recent reconstitution or constituents within the Dow Jones Industrial Average, where's the industrial in there?
Yeah.
Yeah,
you're even getting talks that Berkshire might go into the Dow, right? And replace Nike as
that's more of a fit than Google.
Yeah.
In my opinion.
Yeah. No, Nvidia too, you could put under that realm, right?
But Berkshire would have to be the B shares, and the B shares would have to be split, don't you think?
I would think so, because it's a price weighted index, right?
Right.
So, in order to get in, otherwise it would be 22% of the index,
right.
probably.
Exactly.
Right?
Exactly. So let's talk for a second. I want to just take a moment and talk about some of the tools on Briefing, because let me tell you, I've been on Briefing, I don't even know how many years. It's going on decades. I've been using Briefing. And to be honest with you, I know that I never scratch the surface of what's going on and what I can use. I have things like I use the earnings pages, the eco pages. I use the dual the Briefing Trader with the dual view. I use single views. I use a variety. I'll go on. I will do and listen to the Sentiment and Flow show, as it's happening. Clearly, the earnings rips that are coming out, but there's so much more. There's commentary. There's the brand new, I forgot what you called it actually, the brand new AI little guy down in the corner there.
Yeah. Well, look, you gotta keep up with the Joneses, right? And if you don't have AI on your site, then you're probably running a little bit behind. People want that simplicity for being able to do a quick search and get right to the storyline. They don't want to be sitting there and be like, okay, which story do I need to click on here to get the right information? So one of the things that we do have an advantage of is, Briefing was at the forefront for online investing. We're running our upgrades, downgrades back in 97, 98
right.
At the time. Nobody else was doing that. And that's kind of where we have an advantage on our AI, where our LLM model is built on our database. So you've got a scrubbed database. One of the problems with AI that you can get is you can get bad data fronts in there. You don't know exactly where the large language model is always pulling from. But for ours, it's pulling from our database. So you've got curated data in there that makes it a little cleaner and a little bit easier to read through and more trustworthy, which is a key thing for AI.
But I think that's an important thing that you talked. The word you used was scrub. Now that I can't emphasize enough for people listening, because when you go to sites and you go and you find that ABC stock came out with a 32 cents per share, EPS, and maybe that is comparable, maybe it's not. Is it EPS X items? Is there something going on? What do they do? Do they take something out? Is it comparable to the Analyst? Is it comparable to what they've even put out in the past? And that's one of the great things that you guys do, is you cut through the crap, right? You guys know, look, hey, and I don't even know how many people are on the Briefings team. I do know I've talked to people in the past, a bunch of the gang have been on the show, and they've told me offline too, it's a madhouse during earnings season.
Yeah. I've been through 80 plus now with Briefing, and I started off as an earnings analyst. So that was my, I started the earnings previews that we do and everything. And doing it long enough, 401, there's going to be that flow. 405, boom, there's 30, 40 names hitting on a busy day.
Yep.
And so it's just a mad scramble where everybody, especially now with the remote work, everybody in the chat room be like, I got this ticker, I got that ticker, and going through. But, going and checking to make sure that that's a comparable data, making sure that there's no issues with currency conversions at all or anything that could be in play. Because making sure you're getting the right JP Morgan revenue number there. You're getting the managed revenue instead of the overall revenue, which is the comparable, and understanding if there's only 2 analysts covering it versus 30,
Right.
because that makes a difference in the accuracy of that consensus.
Yeah.
So we pride ourselves in being, if you saw it, I mean, everybody hates earnings season.
I can imagine
3 weeks of hell.
Yeah, I can imagine, because it's nonstop and then it comes out. It's interesting what this does and why I really focus in on the screens, the dual view. What is it called? The
dual in play.
Dual in play. Sorry, dual in play.
Yeah.
Had a little mental block there. The dual in play. Why I focus in on that? 2 things. First, something happens, market goes a little wonky, and you're kind of like, what happened there? And it's like, oh, there it goes. Briefing's telling me that, somebody said something about something. Or the earnings issue is, you see the stock comes out, and if you looked anywhere, it looked like they beat by 5 cents, and they're adjusting, and they're guiding higher. Meanwhile, the stock's down 12%. You're like, okay. Well, the reality, the reasoning was that they didn't meet the whisper, for example, could be, or the stock ran up ahead of this, and the expectation was for that, and they only did this on their outlook, or they had a one-time item in there that we really need to strip out to show what I'm just making this up, but
Sure.
These are things that if you're trying as an individual, an advisor, an investor, a team of investors, a team of advisors to understand what's happening, the problem is there's a lot to cover at once, particularly in those days when you have like 3 or 4 major companies in the afternoon or in the morning, for that matter. So kudos to you guys for that.
Appreciate it.
Let's talk about the market backdrop. You run the Sentiment and Flow show. This is an audio-visual show that you have on Briefing. Who's that available to?
It's anybody who's on our trader product.
The trader product, which is the top product.
That's our high-end product. I've been running that, the audio portion now for last 5-6 years, and it's a chat room, and we got some real savvy users out there, as you said. A lot of smart people that are retired, that are still trading in the markets, investors and everything. So we got a really strong room in there, which is great for trading ideas and investment ideas and understanding exactly why stocks move the way they do. But so it's nice. It's an audio program. We kick it off at about 9 a.m., just about 30 minutes before the market opens, kind of run through what happened overnight, get the trader set up for everybody, and, just a real clear understanding of why we're moving and, what the main drivers are. And we got a real savvy group of analysts that are able to cover that. Pat O'Hare does a great job with page 1, 2, writing that up. One of the better writers that you'll run across.
He's been on the show. Pat's been on the show.
Yeah. Pat's smart as a whip and just a phenomenal writer. So always recommend checking out page 1 to get a good sense. I myself do the TA page scans, which
that stands for technical analysis for people who don't.
Technical analysis, exactly. So so it's got a whole bunch of different trading setups there, but also overall macro look at the markets and everything. But we'll just kind of break in and the top stories, the top movers that are going out there, and explain why they're moving where they are, point out technical levels to people. And then throughout the course of the day, as you said, when a headline comes across, everyone's like, what just happened? And we'll go in and we'll explain it, break it down. And again, we've just got a team of analysts that if you looked at the average length of stay for people at Briefing, there's
long
a lot.
time.
Like, I'm not even the oldest person.
Long
here.
time. Who have I had on before? He's been there forever.
Damon.
He's like
Damon.
Damon's like an institution.
Yeah, he came basically straight out of Stanford, and started working for Dick Green there, and he created the trader product. And he's been on for 30 years. Pat's been on for 27 or so, I think.
Yeah.
So
you're the newbie.
I'm 20. I'm a newbie. I still got some time on a few people, but I mean, I could think of about 15, 20 people with over 10 years of experience at briefing.com. So it's a savvy group of folks.
That's awesome.
That, it's a bit of a skeleton crew at times, but I mean, everybody knows what they're doing and understands the markets, which is great for getting the message out.
One of the things also I like is when you put out your earnings numbers and your even your economic numbers. One of the things I like is you show the importance of it and how it weighs on markets, but that's number one. Number two, although economics, my opinion, nobody gives a shit about it anymore. It's like kind of like we care about it, but it moves markets for 30 seconds and it's like, okay, that was boring.
Well, it's all about what it's going to do for the impact of the Fed, right?
Fed, that's all it is. That's all it is.
Exactly.
I
I guess that's what Warsh is trying to change now at the moment, right?
Hated that. I really, I found that
making econ data great again.
Yeah, exactly. I really honestly found that when I started my career, I was really macro-centric, and I thought that there was a lot of economics that I could look at to build portfolio composition and construct an allocation that would be appropriate for clients based on what I would think were the outlooks and all that. And then the last, 15 years, maybe 10 years, 15 years. Well, definitely the last 10 years. Last 15 years, probably maybe since Bernanke, or maybe since the great financial crisis. I don't know, somewhere around there, it became less and less and less. And it became that there was less importance put on it because maybe the Fed showed, or maybe people believed that there's no longer going to be a downside that's too long because the invisible hand, the Fed put was, yeah, exactly, which I guess was really Bernanke on there. But nonetheless, one of the things you do for economic numbers is you actually put two things. You have a number of, let's say, unemployment, 4.2%. That's briefing.com's estimate. But then you also put the analyst estimate next to it to show where you guys are versus where they are. Yeah.
And it's just to kind of help differentiate. I mean, because you could have outliers on econ data and everything like that. So, we try to give a sense of where we think that the market could be off sides in terms of anticipation. And I agree in terms of for an investor, one data point's not going to change anything. It can have an impact for how a trader reacts. And so, we try to do our previews for the bigger data points and make sure that people are kind of well aware of what the expectations are. And then, if they come in lighter, beat handily, whatever it might be. And from time to time, you will get that one data point that everyone's got an eye on, right? BLS report or CPI report, they've had their day in the sun for having pretty big single day market impacts. That's for sure. So we just try to make sure that there's a good understanding of what the expectations are going into that print, so that people know why the market might react to the way it does.
There's a data point that I haven't looked at in a while, but I used to look at a lot, and now I'm not even remembering the name of it. Maybe you can help me. It was where we looked at the differential between analyst expectations and reality and how far they were off.
The CPI, Citibank surprise economic surprise.
Yeah, because we looked at that, and we always found that to be, what I learned from that over the years tracking it is, one, most economic analysts will try to stick to consensus because that's their job. And the fact is they get too far away from consensus, and what happens? They get fired, right? Because they're wrong. Because the consensus is kind of what it is. You can't get fired if you're like, well, everybody was there too. Well,
No, exactly. Exactly. You don't want to be sticking your neck out too much, right?
But when
maybe
you
a
had
little
that
tweak here or there.
I don't know if you've used this lately, but I got to go back to looking at this because there was a definitive trend where economic analysts would get too excited and then too downtrodden. And whenever those started to miss is when the economics need to catch up, or they need to catch up. So if they were too excited for a long time and economics were down, they would bring their consensus, or they would individually bring their analysis levels down to, or their expectations down. And that would all of a sudden start impacting markets. But again, it's been a number of years that we've kind of gotten away from that, of looking at even the big picture economics, because it was more so what the central banks were going to do, how much money is going to be printed, where they're going, and where they're pointing us to go. That seemed to be, unfortunately, the realities. Would you agree with that?
I completely agree. And that's all stuff I think that Warsh is trying to get away from, right? The idea that let the market be the market, not the central bank driving everything.
Right.
The whole you can't fight the Fed notion and all that, trying to get away from that. And it was a necessary evil during the great financial crisis, and it just kind of built upon that after Bernanke, right? Helicopter Ben and that whole system.
And the communication strategy, that whole thing, which was, they created this thing. I was at a meeting with him, and I remember he was talking about this at a luncheon, and he's talking about the communication strategy. I'm like, wait. The communication strategy? You mean you're going to tell us where you want the markets to go, and you're going to have the parade of what turned out to be the parade of Fed speakers out at every luncheon talking about this, just to adjust, walk back, adjust, readjust, walk back. That's all it was.
No, exactly. And you see that in the dissensions, right? I mean, if you see one dissension nowadays, you're like, oh my God, how's this possible? Right. Because it was such a group think. And again, it was necessary during the great financial crisis. And I just feel like it was just kind of a rabbit hole that they fell down into. And then they expanded it with the summary of economic projections, the dot plots and all that. And they kind of got themselves in trouble with it because, when they're so far off with the transitory inflation story and everything, then all of a sudden, like the credibility started coming into play. Really, all it showed was just how difficult it is to project an economy more than 2-3 years out.
Yep.
Right.
So you talk about leverage and volatility risk, and you've highlighted this. I think one of the most recent sentiment flow shows the fundamental backdrop remains fairly healthy. And leverage, though, and crowded options trading and positioning could amplify market moves, which, by the way, markets are jumpy, even though the VIX is, I don't even understand how the VIX is where it is, but let's move on from that for a second.
16 today.
It's unbelievable. Where do you see the greatest risk of maybe a volatility event, maybe? Because even going back to war, don't forget they walk back stuff every 5 minutes. That's what this market is doing. It's like, well, you said you're going to war, but then we're going to pound them for the next 3 weeks. And then like 8 hours later, like, no, I didn't say that. What? We're only going to do it. It's going to be short. We're going to be in and out. It's not going to be a problem. So is there a catalyst? Is there something that could be a problematic? Or is this kind of like, the bullishness is so strong that it doesn't matter at this point?
Well, I mean, look, the earnings have been so strong. I don't think it matters at this point. At the end of the day, corporate America just kind of keeps the ship afloat. We're looking at a quarter where we're expecting 23% earnings per share growth. It's going to be, I think, the 7th or 8th quarter of double-digit growth, the second straight one at 20% earnings growth. So that's been able to wash away a lot of the geopolitical fears that we have. Now, it's interesting to see we're obviously about to embark on Q2 earnings. We talked about Samsung earlier, Pepsi today. That was an interesting one. They beat on revs. They missed on earnings. They highlighted the potential for increased inflationary costs in the second half of 2026 here. So,
well, Costco came out with comparative store sales that were a little bit weak. And that was a question. Everybody loves that stock, obviously, generally speaking, but just
another one of valuation, right? High valuation. And that was really more just a slower deceleration. It was 8% last month, was 7% this month. And it goes to show people are very sensitive to what the consumer is doing. And we get Delta tomorrow. And that's going to be interesting because that's the high-end consumer. That's company buying. Everybody's expecting a good report. And if you see them start talking about consumers pulling back a little bit, then you might get a little bit more of a red flag on some of the staples and some of the discretionary for sure.
So let's just go back to something and talk about earnings for a minute and earnings season, these double-digit doubles in the 20s and growth and all that. There's a good amount of that baked into those numbers when you look at the index level, market cap based, that are from the big boys, right? If you extract out all those, you still have good numbers, right? There's no question about that. Because you have a trickle down. But a lot of this has been something I have talked about at nauseum, by the way, the circular financing and the vendor financing and the idea that they basically, what happened is the hundreds of billions of dollars that we had on balance sheets for a long period of time, the cash cow concept with Google and Apple, name who you want, Facebook, it doesn't matter, Berkshire, all these companies, right? The major tech companies basically did this. They took, and I can give you further, but I'm just going to give you the big picture. From what I saw, a lot of the money off of their balance sheet and put it into their income statement through circular financing of companies that would actually go and give them money back when they finance them. So you have company ABC that needs cloud storage space. What they did with Microsoft is they said, hey, you know what? I'm going to give you $20 billion or whatever the number is to actually work in your company, but you're going to sign a 10-year agreement with me to buy back on the Azure X amount of space, of storage space, and maybe even compute from other companies. What's your thoughts on that?
Well, that's obviously one of the bigger risks for the AI story. Luckily for the markets, the two biggest drivers of that, OpenAI is private, Anthropic's private. So, there's lots of speculation about revenue growth there and whether or not, you see the stories around China potentially undercutting some of the token costs that are going on out there. So, luckily for the industry, they're not public. Because then people would probably be able to put some of the real numbers together and be like, how are they going to finance it? You see it in Oracle.
Well, I was going to say Oracle. Oracle's the canary in the coal mine for this, right?
Yeah. But, I feel like a lot of that's been pulled back in. I mean, look at Oracle's stock price. It's back down
Clearly,
to what,
low.
135.
Lower than the announcement when OpenAI came out with that $12 trillion they're giving him, whatever it was, right?
Yeah, right. Big number, lots of commas. But obviously that's the key. If you're looking for ground zero on what could kind of implode this rally, that would be it, without a doubt, because then you'd have all of a sudden all that money that NVIDIA and the circular financing has been doing, pulling back in.
Yep.
And but right now the numbers have been real.
Yeah.
Micron, of course, pull away expectations.
Unbelievable. Samsung was a 19-fold increase. Micron, some ridiculous number. Stock up 1,200% in the last however long.
Yeah.
But you spent years and years studying earnings reports, conference calls, and things of that nature. I'm going to throw a couple of things out to you.
Sure.
When you have commentary that shows certain phrases, certain buzzwords, they always catch my attention, like constant currency. I'm like, what's that? When they talk about constant currency numbers, they start all of a sudden, and it doesn't happen for one company. One company does it, and then the rest start doing it, right? You hear the word like framework when they talk about a deal being done. I'm like, it's a framework. It's nothing. What is a framework, right? Constant currency. You hear that. You hear, that it is, some companies will do EBITDA versus, straight EPS. Some companies will have, X special items. What buzzwords kind of hit you when you start hearing some of the conference calls out there, and that concerns you?
In the current environment?
Yeah, no, in other words, if you hear a conference call, every time I hear the word constant currency in a conference call, I'm like, what is that?
I mean, they're never announcing it when it's a tailwind.
Never.
Right? I mean, have you ever heard weather be a tailwind for any retailer?
Nope. We had beautiful weather. A lot more people came out. No, it was execution.
Yeah.
It was execution. The management executed well. Yeah, they had the sun.
Because it was sunny.
Exactly.
But yeah. So I mean, this time. So what I'll be listening to a lot. I'd listen to a ton of calls. And with AI, it's great now too, because you could just grab a conference call transcript and just kind of put in different, set it up look for these buzzwords. And the buzzwords that free cash flow. Is going to be the one that I'm looking at real close this time. Obviously, that's where a lot of the traders are watching pretty closely. You see that with the hyperscalers where they went from asset light to all of a sudden a heavy asset company. So free cash flow and margins are going to be the key thing to watch here. That's why you saw Pepsi kind of react the way that they did. Their operating margins were actually better than expected, but it's the forward outlook for these margins that there's some concerns about. But
free cash flow and the tech companies are going to be the big one, because they're going to go they have to go from here to way down.
Oh yeah,
there's no question.
I'll shoot it over to you after. There was a chart today. It was Morgan Stanley that showed the cash flow of hyperscalers to semiconductors, and it's just an inverted parabolic move from where it had been going over the last couple of years. It's just amazing when you see it in an actual chart. And I mean, that's obviously the big story on the backdrop of the markets. But now, luckily enough for a lot of these hyperscalers, they got the revenue to back it up.
Clearly.
Right? So
they do. For now, the question is, how is that going to go? All right, well, I mean, I think it's going to be really interesting to see what happens here. But I agree with you 100%. This whole issue of free cash flow is going to be a big one. Margins, again, they'll probably start throwing gross out at us rather than net. Who knows how they do this?
Yeah.
But
yeah, that's exactly what they'll try to do. A little financial engineering or signal engineering, I guess we could call it on a conference call.
Yeah, on the conference call, they'll do that. We had a great gross. Really? Okay, good. What did you take out? What are you not including there somehow?
Tariffs or oil and prices.
Well, that would be another thing. Nike said they're going to have another $950 million they're expecting from tariffs, but who knows what the timing and when that's going to come. There was just like they just like threw this out there out of nowhere. It's like, what?
That's a perfect example of, cutting through the noise when all of a sudden they beat by 60 cents on the bottom line. You're like, well, what happened there? Is this turnaround plan starting to come in? And you go in and be like, well, it included in a $750 million benefit from IEPA refunds and everything.
Right.
So, I'm not expecting tariffs to be a major story that this quarter by any stretch of the imagination, but certainly oil prices, right? And you'll get people trying to be dismissive of them. And it'll be curious because the linearity of oil throughout this quarter has been lower. So I'm really curious to see how people address that, especially with forward-looking guidance.
One of the things I look at, I'll close on this earnings issue. One of the things I always look at is when we have numbers that come out that are weak towards the end of this quarter or strong, depending on how you want to look at it. And then we look back what they had estimated where we are, and it shows that the potential is for a major drop off. Like, in other words, you could see by where they are, what happened to the quarter on a month if they share any information on like retail on a shorter term basis, and then they do an estimate of the year. It's like, wait a minute, you're putting this number down, and you have like a 60-cent beat this quarter, but you're not changing your annual. What happened there? That means that's a potential real red flag for next quarter.
That's a concern. Now, it is the company's business to kind of sandbag a little bit and lower those expectations.
Right.
That's why you generally see over the course of a quarter downgrading their estimates, right? On average, earnings per share get downgraded about 2 to 3% from the end of one quarter to the start of the other. This time around,
this time's different. Majorly different, right?
March 31st to current day, they're up 3.4%. Which is a big swing from the normal process that we see of people sandbagging and lowering those expectations. And it's the game that's played with the analysts and the companies. They want to be in their good graces. They want to give them a lower bar to beat.
Right.
Not a low bar this time around. And that's what's going to make this. Now, I think that they'll beat it or they'll at least meet it. But as we've seen, if you come in line against high expectations, your stock's going to be down 5 to 10%.
Yep. And they'll try to buy it, by the way, and then they'll try to buy it back that morning because nothing can stay down. Here's my closing question for you. And of course, people could go over to briefing.com and check out all the different things that are available on that. Go over to the disciplineinvestor.com. We'll put some links in there as well for the episode number 981. So here's a question. What chart, maybe a chart, what chart, I guess that's a good start of this, is sitting on your desk every day that investors should see? Like, what do you look at? What's like, I need to have that. If I don't see that, I can't start my day. Goes along with my coffee.
Core 1M.
41M.
Core 1M.
Oh, Core 1M. I'm like 41M.
Yeah. Core 1M. So that's basically the measure by the CBOE of individual options, or individual stocks being traded in options versus the index options, right? Right now, we're at an extreme level at the moment. I didn't check in the last couple minutes here, but it was running right around 5 or 6. Anything above 8's at an extreme level. And it's to your point where we basically have a solid base for the SPX right now.
Mm-hmm.
But there's that little bubble up above it that's causing that volatility that we see where we're down 1%, up 1% one day.
Right.
And that core 1M, what it does is it measures how many people are leveraged in these individual stocks, primarily names like Micron and things like that. And I'm keeping an eye out on that because right now that tells me that there's going to be a lot of chop and volatility at the high end of the markets, but we're staying within 2 to 3% of the all-time highs, which is fine. If we start seeing that pulling back a lot, then, I'm going to be real curious to see, is that going to just kind of blow the froth off the top of the beer and you'll still have that good beer there to drink and everything?
Right.
Or was it a bad pour, and there was just way too much froth in that beer, right?
Yeah.
And you got half a beer there, and all of a sudden you're like, oh, I want my money back, right?
Exactly.
Taking the money out.
Yep.
So that's the one chart that I'm watching. I know it's not a popular chart to follow, but for me, in terms of trying to understand where the volatility is and where the leverage is and where the risk is, I like following that a lot over the last couple of weeks, because options activities just become such a key driver on a day-to-day basis. I want to kind of see through that noise and understand where the base of things stand right now. And we're not seeing panic by any stretch of the imagination. It's the potential's there given the leverage, but that would be the one thing that I'm keeping a close eye on. We're not seeing extremes in other areas in terms of sentiment, for sure. Of course, sentiment's been that way for years now. Bitter's the new black on the sentiment data.
Right.
And then positioning, it's high, but it's not at extreme levels where you're like, oh, I need to take my money out. Cash levels as well. So for now, I just see a choppy market near the top. We'll see how earnings unfolds, and obviously the price reaction to a lot of these earnings, that's going to be a key tell. But as long as the earnings stay strong, the market should stay there, and therefore, the buy the dip mentality needs to kind of continue to be in play.
We'll see that.
But you also don't have to chase at this point.
Yeah, clearly not. Gavin Maguire, briefing.com, a load of information, a wealth of knowledge. I appreciate it, and I'm looking forward to talking to you soon. Hey, all right, we'll talk soon.
Yeah, definitely. Thank you so much.
Thanks. Gavin Maguire, great stuff. First time on the show. We've had briefing on for years. I've told you all about it, why I love them. Hey, I want to remind you, we talked about it before we got to Gavin, but again, if you have a situation where you were kicked out, you were just kicked to the curb by Microsoft or Amazon or Meta or any of these other major firms, and you have some questions on what to do next with some of the benefits packages and where you're going, we're here for that. We did do a lot of that, and that's something I would say, specialize in. So make sure to go over to thedisciplinedinvestor.com. Click on the button that says Ask Andrew or Contact Us or something. Figure a way somehow to get in touch with us, and we'll make sure that you are set and in good shape. With that, we're going to wish you bid you adieu. Next week coming up is Tom McClellan, the master at cycles and indicators and understanding what's happening with markets. So make sure to stay tuned with that. Go over to YouTube, Amazon, Apple, Spotify, wherever you can find the podcast, you'll find us. Thanks for joining me again this week and every week. Don't forget, Horowitz & Company is our new Instagram account. We're going to be posting some snippets. You can see what we look like, how we do it, what we're doing from the show and other things. So make sure to do that on a regular basis. Horowitz & Company on Instagram. Sign up for that, follow us, and do your thing. I'll speak to you soon. Thanks so much. This podcast is intended for informational purposes only and does not constitute personalized investment advice. Investing involves risk, including the possible loss of principal, and past performance is not indicative of future results. The views and opinions expressed are those of the host and any guests and may not necessarily reflect those of Horowitz & Company, Inc., an investment advisor registered with the U.S. Securities and Exchange Commission. Registration with the SEC does not imply a certain level of training or skill. Advisory services are only offered to a client or prospective clients where Horowitz & Company is properly registered or is excluded from registration requirements. Any mention of third-party companies, products, or services is provided for informational purposes only and does not constitute an endorsement. Hypothetical scenarios or forward-looking statements are for illustrative purposes and should not be viewed as guarantees. Content is intended for U.S. residents only and may not be applicable in other jurisdictions. Listeners should consult a qualified financial advisor before making any investment decisions. Please visit our website for additional information, disclosures, as well as a copy of our Form CRS. Advertisements are not related to the host or affiliates and are not considered recommendations by the host of the show or any affiliates of Horowitz & Company.